Thank you for attending the latest installment of the Options Industry Council's webinar series. My name is Alexander Osinga, and I'm a staff member here at the OIC. I'll be guiding you through today's session, Earnings Season, what option strategies to consider. We're glad you could join us to learn more about options as a flexible, powerful trading tool. In today's webinar, hosted by NYSE's Bill Ryan, we'll be discussing the upside and downside of various option strategies during earnings season. We are excited to welcome Bill back to the OIC's webinar series. He is a managing director at NYSE Options and has over 30 years of experience in the option space with a background in retail options trading and strategy. Today, Bill will take us through the different option strategies to consider during an earnings season. And now, ladies and gentlemen, Bill will introduce our topic today, earnings season, what strategies consider. Bill?
All right, thank you, Alex. Welcome, everyone. Today we talk about options and earnings. It's a big topic. As you know, when we go through the OIC monthly webinar series, we pick one, and we'll have a discussion today, or I'll be talking about earnings season and some different strategies, and I'm sure Alex will talk to you later about what's to follow and a panel discussion on the same topic. So let's begin today. Let me move the slide here. Before we begin, I have to tell you some of the things our lawyers make us talk about. Here's a full disclosure. Please take time and read it. But I want to just reinforce a couple points here. And one in particular is that options involve risk and not suitable for everyone, but they're a great tool and everyone should learn how to use them and when to use them. And the other is that in all of our examples today, we do not figure in commissions, fees, taxes, anything like that. And that's to make the math easy. But we all know when we trade options that commissions, fees, and taxes are very real, and they will affect the profitability and the loss characteristics of each of the strategies that we talk about. So when you go home and you look at some of these strategies, make sure you figure out your commissions and understand your tax situation. So who is the OIC? Well, the Options Industry Council is a partnership between the Options Clearing Corp and the options exchanges. And we get together and we work to develop curriculum to teach people the proper use of options and make sure that individuals understand the risks and rewards associated with options. And if you look on the screen, you'll see the listed options exchanges. There's actually 5 exchange groups, and together the 5 exchange groups actually own 15 options exchanges. For example, the CBOE has 4 options exchanges. The NYSE has 2. BOX has 1. MIAX has 2, and NASDAQ has 5. So we have 15 options exchanges owned by 5 options groups. This is an interesting slide. It shows the growth of options from 1973 when we started through last year, 2016. And you'll notice there's a couple of years in here, starting around 2000. We had a pretty straight climb up until 2011, that is, when we had our best year. What happened in those years, a couple of things happened. We had the options exchange, the International Securities Exchange, join us, and they brought fully electronic trading to the options world. And also in that time, we listed ETFs and we listed options on ETFs, and that's become a very popular product. So those are some of the reasons for growth, but you see how popular products become. We had a couple of down years of the last 2 years, but we're holding pretty steady. Not bad for an industry that's only been around since 1973. So tonight, we're going to talk about options and earnings seasons. First, we'll talk about implied volatility and its effect on options. We'll look at the long straddle and strangle. We'll look at short straddle and strangle, some backspreads, and in particular, a callback spread. Now, we're going to cover a lot of stuff tonight, and I'm going to be moving pretty fast. I'm one of 6. When I sat down at the dinner table, if you didn't speak quickly, if you didn't speak immediately, you weren't heard. So I tend to speak fast, and people tell me, being from New York, we tend to speak fast as well. But we're going to cover a lot tonight. Don't expect to come out of here as an expert. You will come out of here with some ideas. Hopefully, a light bulb or 2 go off during our conversation, and then you'll take that idea that you have and you'll do some further research and see where these strategies work best for you. Okay, so let's talk about implied volatility and its effect on options. Something that's pretty obvious, but a lot of people don't really think about, is that an option is only worth its intrinsic value at expiration. That's it. It's intrinsic value and nothing else. There's no time value left. The option is expiring today or tomorrow, and that's it. There's nothing left. So it's only worth its intrinsic value at expiration. But what happens during the time you own the option, before we get to expiration, is where the implied volatility comes in. And implied volatility changes dramatically. It changes quickly. It changes intraday. It changes overnight. And those changes change the price of options. And those changes might make you decide to do something differently than you had originally planned. Now, when we plan to trade in the option world, we look at what we're going to buy. We look at what we expect the stock to do. We look at the Greeks. We look at the delta and the theta to see what's going to happen with the price of the option. The stock moves and what's going to happen over time. But we don't look at the volatility a lot of times. And the volatility is one of the most important factors in option pricing. An increase in volatility will increase option prices, and a decrease in volatility will decrease option prices. And that's an increase in both calls and puts and a decrease in both calls and puts. You know, volatility is not directional. It's a measure of risk. So high volatility doesn't mean a stock is going down. It doesn't mean a stock is going up. It means that it has a lot of potential for movement. And that potential in movement is what might make you decide to do something. And it might help you make a decision as to whether you should stay in a position or get out of a position. So any long or call put position will take advantage of increases in implied volatility, and they can suffer with decreases in implied volatility. A short call or short put position will take advantage of a decrease in volatility and can suffer when increases happen in volatility. Now remember what I said on the last slide. Any increase in volatility will increase call and put values. Any decrease will decrease call and put values. So if we're long a position, whether it's a call or a put, we want volatility to increase because we want the price of our option to increase. If we're short, we want volatility to decrease because we want our option price to decrease. Now, the last bullet point here is pretty interesting. The effect of changing implied volatility varies with complex strategies or those with multiple legs. So we're going to talk about straddles and strangles today. But anybody out there that uses spreads will understand that if you buy one option and sell another, you're buying volatility and selling volatility. And sometimes they offset. Sometimes the offset is not 100%. It's usually not 100%, but there is an effect. And when you do a spread, you have to be aware of that effect that volatility has on that spread. So long straddles and strangles are typically strategies that want volatility to increase. You buy two options. You buy a call and a put when you buy a straddle and a strangle. So you have exposure to volatility on both the call and the put. We need both to move, and if they don't move much, we need a big move in the underlying stock, either up or down. Now, a backspread, either a call or put, that involves buying more options than we sell, and we hope to profit from the long options. We hope that the profit from the long options outpaces the loss on the short side. So again, that's, backspread is buying one and selling another one, and we have some volatility moves in there as well, but we're hoping to profit from that change in volatility. All right, we have a poll question coming up here now. So what we ask everybody is a simple question. Who looks at volatility before they make a trade? So when you're planning the trade, do you look at volatility? And yes, our answers are yes, no, and what's volatility? Let's take a few seconds for everybody to answer that. Okay, so listen, that's pretty good. We have 75%, 76% of our audience says that they do look at volatility before a trade. 17% said no, they didn't, and 7% said what's volatility. So let's start at the bottom. What's volatility? Volatility is a measure of risk. And, if you have higher volatility, you have higher risk. If you have lower volatility, you have lower risk. And the risk is what helps the option prices change. And think of it from the point of view of selling something. When you sell a call or a put, you assume risk, right? You assume the risk of short stock with a short call. You assume the risk of long stock with a short put. So you need premium to offset that risk. You have to take a certain amount of premium in to offset your risk. So the higher the risk, the more premium you're going to want. So that's a very basic definition of volatility and why it's important. Because if you look at volatility, you'll know how risky a stock is, what you should or shouldn't be doing in it. So the next question is, especially for those who use volatility, look at volatility as they enter a trade, who uses volatility to determine when to exit a trade? So we have uses volatility, does not use volatility, and not sure. So I guess the people who ask what volatility is, you're a not sure guy, but let's see what everybody else has to say. All right, so we have 30% of our audience says they use volatility to help them determine when to exit a trade, and 49% say they don't use the volatility, and 20% are not sure. So let's go right to the uses volatility. Congratulations, that's a great thing to do before you exit that trade. Look at that volatility, see how it's changed, see if it's made you rethink your position and your thought in the stock and how this trade was going to work. And an example is we're buying a call, and this comes in very handy when you're playing for earnings. Earnings come out, we know they're coming out. We know it's coming out 5 weeks from now or 6 weeks from now. We buy a call option because we think that the earnings are going to be good and the stock is going to go up. Now, going into earnings, volatility will increase. So if we watch our price of our call option go up and go up and go up, we can check the volatility and see how high that's going. And when it gets to a point where it seems like it's probably abnormal, it's a little high, it might tell us that volatility is going to drop. And even though earnings haven't come out yet, it might be time to sell that call. Now, I'm not saying definitely, but it might be. So you can use volatility in that way to determine whether you should or shouldn't sell the call or the position. Some people might ask, what is considered high volatility? Well, it's always different for different stocks. If you go back a few years, I can remember when Taser had volatility of 200. That's very abnormal right there. You just look at that number, it's high. So utility stocks will have a little lower number. Tech stocks might have a little bit of a higher number. You really can't pinpoint a number and say, 40 is a high volatility. It depends on the stock. And what you can do, and we're going to talk about implied versus historic in a few minutes, but you could look back at historic volatilities and use those to determine whether volatility is high or not. So for those of you who do not use volatility, start using it, take a look at it, get comfortable with it. And for those of you who are not sure, do a little more research. We're going to talk about volatility a little bit coming here, and the OIC I know has some volatility classes, online. Take a look at the volatility class and see how it can make you a better trader. So a long straddle is a trade where we buy one call and we buy one put. Both options have the same underlying stock, the same strike price, and the same expiration month. And we're looking to take advantage of increases in volatility, or we expect a significant move in the stock. So again, we're buying a long call, we're buying a long put, same month, same strike price, same stock. So here's our example. Our stock XYZ, if you attend a lot of OIC seminars and webinars, XYZ is our favorite stock. So XYZ is currently trading at $50. We buy one of the January 50 calls. We pay $3.20 for that one. And we buy one of the January 50 puts for $3. Now, that's a net cost of $6.20. So we bought the 50 straddle for $620 or $620. Now, when you look at this, first you have to think to yourself, what am I doing here? What am I expecting? Well, it cost me $6.20. So I need a big move in the stock. I need to cover $6.20 worth of expense to make a profit here. So do I expect my stock to go above 56.20? That's on the upside, right? That's my break even. Or 50 minus 620 debit for the put going down. So I need a big move in the stock, right? So I'm not predicting definitely that the stock is going up. I'm not predicting definitely that the stock is going down. I am predicting that it's going to make a big move, and it's going to move $6.20 at a minimum. Now I'm going to fill in some of the blanks here. All right, so we have break-evens we're showing here, 56.20 on the upside, 43.80 on the downside, and you can see how the profits and losses and the calls and the puts offset each other, and we get to zero. So we have something to remember with the long straddle is we have two break-even points. We have a higher break-even point and a lower break-even point. Now, when I fill in the middle, you see that our greatest loss, $6.20, occurs with the stock right at the strike price. And that's because at the strike price of 50, neither the call nor the put is in the money. Both of them will expire worthless, and we lose the $6.20. But if you look at the table, as we move above 50, to 55, now the call has some value. So I lose a little less money. In this case, I'd lose only $1.20. Or if the stock went down to 45, I'd lose a little bit less money. I'd lose only $1.20. Because one of the options, as the stock moves up or down, one of the options is going to be in the money, either the call or the put. Now, if I'll fill in again, you see at 60, I make $3.80 on the straddle, and I make $3.80 on the straddle when the stock comes down to 40. So as the stock goes up or down, I make money, and I have an unlimited upside potential for the call, because once this call keeps going up, we lose the $3 on the put because it's out of the money. I just keep making money in the call as it goes up. Now, as you know, with long puts, we have a limited potential for profit because stock can only go to zero. Right, so if the stock goes to zero, I'm only going to make the break even here of 43.80 if the stock is on the downside, but I have unlimited upside potential here. So what we're showing you with the table here is that we need a big move in the stock to make money. Now, the stock can move and help us make money, but something else can move and help us make money, and that's the volatility of the stock. If that stock volatility increases tremendously, you can see an increase in both the call price and the put price. And if the call price and the put price both go up, we still have the ability to make money here. So going into earnings, volatility usually increases going into earnings starting, 4, 5, maybe 6 weeks out. Everybody knows when earnings are coming. It's not a surprise that they're coming out, but what could be the surprise is the actual number. So when you buy for earnings, you're going to have to buy further out to get in before the volatility increase starts. So here's what the straddle looks like on the graph. And you'll see that deep V, right? That deep V, that's your loss. That's your maximum loss of $6.20 with the stock at 50. And you can see how the line climbs up to the break-even points of 56.20 and 43.80. Now, I want you to remember that deep V because pretty soon we'll be talking about the strangle. And I want you to remember the deep V here because it's important to see the difference between the two. But what we're looking for, again, here is a big move in the stock or a big move in volatility, a big upward move in volatility to bring both the call and the put prices up. So here's the long strangle. Now, with strangle is similar. We're buying, calls and puts on the underlying stock, same underlying stock, same expiration month. But what we're doing is we're buying the out-of-the-money call at a higher strike price and buying the out-of-the-money put at a lower strike price. So we're separating the strike prices. Rather than being the same, they're going to be separated. And that's what gives us the flat bottom. You notice that flat bottom on the graph off to the right? That's what gives us that flat bottom. So our example here, XYZ is a 50. We're going to buy the 55 call, pay $1.40 for that. And by the 45 put, we'll pay $1.05 for that. That's a net debit of $2.45. So we're looking for a move in the stock again, but we only need to cover $2.45 this one, much less than we needed to cover before. But there's a difference here, and that was that flat bottom. So when I fill in the graphs, the table here rather, you'll see the break-even points, 57.45 and 42.55, two break-evens on the upside and the downside, a little closer than the other one, than the straddle before. But when I fill in the middle of the chart, you'll see the $2.45 loss on the right-hand side. $2.45 goes from 55 to 45. It's $2.45 at $45, at $50, at 55. That's that flat bottom. There's not that one point when we hit the 50 where it moves up or down and we get a little bit of profit. We could have 100% loss with this in those strike prices, and we don't start to see differences until we get to the break-even points. And then, again, we have unlimited upside on the call, and we have a substantial profit potential on the downside. With the put. But you see the difference. This is cheaper. It's cheaper, but you have a greater potential for 100% loss when you do the strangle because of that flat bottom. And here's again what it looks like. See that flat bottom? I can't tell you enough that flat bottom, that's all the same loss all the way across there from 45 to 55. Different than that deep V where the most loss occurred at $50. All right, so straddle versus a strangle, right? Straddle has a higher cost than the strangle does, and it's lower leverage. Higher cost is usually lower leverage. The break-even points are closer together, which means that you can make a little bit of money on a move up or down, so you have less chance of 100% loss on that trade. The strangle has lower cost, which gives you a higher leverage. The break-even points are further, so you have a greater chance of that 100% loss. In both of them, time decay, theta hurts us. We're long options. Time decay hurts long options, and we need a big move in the stock. But both of them also benefit from a big move in volatility. Now, the strangle is a little cheaper, so it wouldn't need as big a move in volatility as the straddle would. So if you're thinking about earnings, playing earnings, and you're not sure exactly which way it's going to go, you're playing the volatility part of earnings, maybe you look at the straddle or the strangles and see how you like those. Now, if you're looking for just a pure play up for earnings, look at just buying the call option. Buy the call option a couple weeks out. You don't need, if you're pretty sure that the stock is going up, earnings are going to be good, you can look at just buying the call option and hoping that the call option increases as volatility increases going into earnings. And then you have a decision to make. Do you keep that after earnings? Because the after earnings volatility usually comes down because the unknown is now known, the risk is gone. So the volatility will come down, so the option price will come down. So you have to decide before earnings, do I want to sell that call first and take advantage of the high volatility, or do I want to wait until the earnings announcement comes and see how the stock moves after the earnings announcement? It's a difficult decision, but something that you have to look at and make for yourself. All right, so we'll talk about a short straddle and a short strangle. The short straddle, the opposite, obviously, of the long straddle. We sell calls and puts at the same strike price. And it's not something that we teach. We don't like to teach people to do uncovered calls and, in particular, uncovered calls. We will teach uncovered puts, but we teach them as cash secured puts because our risk is defined and the money's in the account. But if you're getting close to earnings, you see, you're getting closer and you've noticed that volatility is increasing, we can take a look at the volatility and say it's rather high right now compared to historic volatility. I think I should actually sell these options because the volatility is going to come down and the call and put prices are going to come down, and I need to take advantage of that. Now, it's very risky when you sell the short straddle because the call carries unlimited risk. You're short a call, you have unlimited risk. You're going to have to put a lot of margin in the account. And the put carries the same risk as the stock. Now, a lot of people like to sell short puts, and they accept that risk of the stock because they don't mind owning the stock, and it's the same thing as owning the stock. But the short call is the very hard part of this. The risk is unbelievable with that short call, and not something we recommend. If you like to do that, if you like to sell options like that, you may consider selling a credit spread. So we're going to sell a call option. We're going to take in the premium from that call option, buy a further out of the money option. We're going to have to pay a little bit for that, but that's going to, stop us out basically on the loss on the upside because the risk will be defined by that spread. So if you like to sell and going into earnings, you're probably better off selling a call spread or a put spread than you are a short straddle or a short strangle for that matter. So the short strangle, again, is the opposite of the long strangle. The strike prices are further apart. You still have unlimited risk with the short call. You still have substantial risk with the short put. Again, not something that we would recommend. We don't recommend that you take naked positions, short naked positions. We like to do covered calls if you like to sell calls, cash secured puts if you like to sell puts. And again, if you like to sell, think about doing the credit spread. All right, let's talk a little bit about backspreads. Backspreads are similar to vertical spreads. Again, we're buying calls and selling calls at the same time, all the same stock, all the same stock or ETF, and the same expiration month. But the difference between a backspread and a regular spread is that we buy and sell different numbers. If we buy 2, we sell 1. If we buy 3, we sell 2. If we buy 4, we sell 2. We have a ratio. It's not necessarily a set ratio, but we have a ratio. But we always buy more calls than we sell. If we do puts, we buy more puts than we sell. We always buy more than we sell. by buying more than we sell, we never have any naked options. We'd like to do these for a credit. If we could do them for a credit, we're in better shape than if we do them for a debit or net money. Obviously, we like to put money in our pocket, and that's going to depend on the option prices, and the ratio that we use is going to depend on if we use the deeper in the money, the at the monies versus the at the monies. Depends on how you set it up, but we like to do them for a credit. We have a profit potential which is unlimited. And I don't really like to say unlimited in the case of a put spread. I'd rather say substantial profit potential unlimited for a callback spread, but substantial for a putback spread. And the loss is limited because that naked option, we don't have a naked option, rather the short option is always covered by a long option. So again, we buy more than we sell, that way we have no naked contracts out there. So again, each short option is covered by a long option. That's simply a vertical spread, either a call spread or a put spread. The long is always the extra option. Now you're going to need margin for the spread. So credit spread requires margin, and the margin is the difference between the strike prices less the premium that you bring in. So you're always going to put some kind of, even in a credit spread, you're always going to put some kind of margin in the account, and you need special approval from your broker to do spreads. So let's look here where we have a bullish call. An outlook on stock is bullish. We would do a call spread. If it's bearish, we do a put-back spread. Again, we expect a dramatic move in the underlying price, and that dramatic move in the underlying price could come from the earnings. If the earnings are up or the earnings are down, we could have a big move in the stock. We could get a dramatic move in the option prices because of the volatility change. So the stock does nothing. The stock is just kind of moving along at its regular pace. Volatility is increasing because earnings are coming in a few days. Everybody knows they're coming. Volatility is going up. What are the earnings going to be? I don't know. They're going to be good. They're going to be bad. They're going to be the same. There's risk. As the risk increases, the volatility increases. And, our spreads, our option prices will increase with the volatility increase. Now, with the spread, if we buy 2 and sell 1, we have 2 that are increasing in value because of the volatility, and 1 that's increasing in the value because of the volatility. The 2 long side should offset the 1 short side. Now, I say should. Nothing, is a given in the options world, but that's our goal, to have the volatility increase and have the 2 long ones increase greater than the short one increases. So here's an example of a call back spread. We're going to buy 2 calls. In our example, we're going to buy 2 and sell 1. Again, we're always buying more than we sell. Generally speaking, we buy the out-of-the-money calls. We sell the in-the-monies or the at-the-monies. The in-the-monies usually have a greater premium than the at-the-monies have, and that's how we work out whether we're going to end up with even a debit, even, or a credit. If you sell the in-the-monies, you'll bring in a little more credit. Maybe you'll end up with a credit versus the at-the-monies, where you may end up with a net even. Now, the greater the strike price differential, the further apart they are, the greater the risk of the spread, because you're short one, you're long the other. You're short the lower price, long the higher price. That's greater risk in the middle. You called away at the lower price, you have to buy at the higher price. The wider that is, the greater your risk. So each short call, again, covered by a long call. That's a credit spread or a bear call spread. We're long the extra call. The long calls are fully financed by the short call. That's what we're hoping for. And, time decay or theta, the short call hopefully offsets the longs because we're making money as time passes. So hopefully that short offsets the longs as far as theta is concerned. So what we hope happens here is that the profit on the upside is unlimited, again, depending on the number of extra calls. The downside is limited because it's a call spread, right? We end up with a call spread. If we buy 2 and sell 1, we end up with a call spread. 1 and 1 is a call spread. The extra one is the extra call that goes up. That gives us the unlimited side. The call spread defines for us our net potential loss. It's defined by that spread. So a call back spread is really a bullish position. We're hoping the stock to rise. We want the spread part of it to max out, and we want the long call to go up as high as it possibly can. So here's what it looks like in a graph. It looks like in a graph, and we tell you in the bullets here that the increase in volatility typically helps that position. And think about it: we're long 2 and short 1. If prices go up, the 2 longs should offset that 1, and hopefully offsets that 1 to a nice degree that we can make some money here. At expiration, we have to be careful at expiration, because if the stock closes at or below the strike price, all the calls are out of the money and worthless. So we know what our risk is. Our risk is either if we did this for a debit, our risk is the debit. If we did it for a credit and everything expires worthless, well, at least we got the credit, right? So if we do it for credit and expires worthless, that's not horrible, because we still have some kind of credit. We got basically a consolation prize. It didn't work out exactly as we wanted, but we got a consolation prize. But if we did it for a debit and everything expires worthless, then it cost us money. So the risk is not on the downside. The risk is that the stock lands at exactly the long strike price. That's the maximum risk involved here. And when you think about it, if the stock goes through, actually the short call's already in the money. If the stock continues up and stops at or just below the long side, the longs will expire worthless. The short is in the money. We're going to have to buy that short back to cover it, or be assigned and end up selling stock. So we have to buy that back, but we can't exercise the long sides because the stock didn't go through the option, and the option is not in the money. We really want this to go through the top strike price. Through the top strike prices, the long start making money to offset the short. I know it's a little difficult, for people to understand that we're hoping that it, we're hoping that it either stays where it is, expires worthless, and we get the credit, or we need that move through the top strike price so we can start making money. All right, so here's an example. We're bullish on XYZ. We expect a sharp rally in the next 60 days, and that could be, earnings coming out. We think this is going up in the next 60 days. We think XYZ implied volatility is going to stay about the same or increase. Now, anytime that you buy a call option or buy a put option, you're hoping for a volatility increase. That goes without saying. So we're going to go in here and do this. We're hoping that volatility is going to increase. So we're going to do a 2-to-1 called backspread, and we're trying to do it for a small net credit. So speculation, stock's going to go up, earnings are going to be great, stock is up. That's how we make our money. We have a profit, a net profit if XYZ declines. If we do this for a small credit, the consolation price here again is that credit that we get to keep. The trade-offs here, there's a trade-off for everything in the options world. A slow rally can result in a loss. A small rally not through the strike price, just to the strike price. That can hurt us because we end up buying back the call option, which is going to cost us money. All right, so here's an example of what we're going to do. We're going to sell one of the 45 calls for $3.50, buy 2 of the 50 calls at $1.25. That's $2.50 total. So our net credit here is $1. So we have 1 short option, 2 long options. The 2 long options are the 50 strike. The 1 short's a 45. If we pair off 1 long with the short, we have a 45-50 bear. Credit spread. So we can make some money in that credit spread right there, and then we can make money with the remaining 1 long 50 call. A lot of numbers here. We'll go through them slowly. Here's our break evens. 45 on the upside, 46 on the downside. And if you go down to $40, you see that our profit is $1, right? So our profit's $1. We'll short the 45s, long the 50s. At 40, all of that is worthless. None of them have any value. We did it for $1 credit. We keep that $1. We make $1. In the middle is where it gets a little tricky. Take my word for it. In the middle where you can't read it, that's where you lose the most money, because that stock is going up and it hasn't gone through the 50 strike price yet. Once it gets to 52, it starts getting a little bit better because we're making money on the long calls now. And you see we get to 54, we're even, but your greatest loss is at 50. I know you can't read that, and hopefully you can get that fixed, but you can't see that at 50 is where your greatest loss occurs. At 52, the 50 calls start to have some value, so it offsets a little bit of the loss. So we start to make some money there. 54 is the break even, and above that you see 55 and 60 is where we really start to make the money. And 60, 70 we're making money. Our two longs are offsetting the one short, and we're happy with that. So early assignment is always possible when you sell something. You can be called away for a dividend if it's a large dividend-paying stock. Somebody could come along and call and want your stock and take you away. It's something that you have to remember. If that happens, you have a choice. You can exercise the long side to get the stock if it's worth it. It might not be worth it yet because it might not be in the money, but you would have to go out and buy the stock back if that happens. If it closes between the strikes, that's your risky part because you're going to be assigned on the short call. You have to go out and buy the stock, and if you go out and buy that stock, you could end up losing money that way. So when you put on these spreads, like all option positions, you pay attention during the life of the contract. If you start to see things that's going up too high, too fast, maybe it's time to close that. Volatility is increasing tremendously. Am I going to get called away? Is there a dividend, like we mentioned before? Is there a dividend in the middle of this? You have to pay attention to these spreads. You have two legs, but at a ratio they're uneven, so you really have to pay attention to these. So a quick move can give you a good profit here. The sooner the better with these things. Why wait? If I can get my money in 30 days rather than 60, I'll take my money in 30 rather than 60. If I can take, if I get to a point, when you have a spread on, it gets to a point where it can't increase any more in value. So if that happens in a week, why not close that spread, take that profit, and then move on. So you have to pay attention to these, pay attention to the prices, look at the volatilities, go back and find out what happens with them and see how it's affecting the price of your option. Maybe the volatility makes you change your mind and exit the strategy earlier than you had originally anticipated. So strategies that want the implied volatility go down, short straddles and short strangles, we want them to go down, and that's what we think is going to happen when volatility is very high. Going into earnings, we think it's very high. We can sell the straddle or the strangle, looking for that decrease in volatility. Again, not something that we recommend. We don't recommend that you take on uncovered short calls and the huge margin requirement associated with that. If you like the short puts because you don't mind owning stock, you'd like to own stock, then the short put is fine. Just make sure you do it as a cash secured put where you have the cash in the account to cover any assignment. Ratio spreads, involving buying more options than you sell. Again, pay attention to those. We want volatility in there. We want that to stabilize. We want to take a look at that at the short strike price. We want to take a look at that. And remember, when we have these short options, whether it's short calls, short puts, volatility is in there. These are unlimited risk strategies, especially with the short calls. Short puts have substantial risk associated with them, something that you have to pay attention to. Something that you really need to look at. Okay, we went through that pretty fast. One thing that I want to go back and talk about that we didn't have in the slides. We talked about volatility, and a lot of people always question, how do we know what high volatility is versus low volatility? If you take a look at, go back and look at historic volatility charts, you can look back at those and say, well, especially in relation to earnings, go back 3, 4 earnings cycles and look at what happened to the stock. Look at historic volatilities for the stock then and see how it moves. If it starts moving, 3 weeks ahead, look at 3 weeks ahead. Plan your next trade around that 3 weeks and look at your options now. What are they doing? Are they moving? Are they kind of laying low? What's going on? Get a feel for it. There's no sense in going out and buying an option 6 months ahead of earnings, waiting for that increase in volatility. When earnings are coming, you don't want to play the near earnings, you want to play the far term, but you have 6 months. Look at what works best as far as timing and price is concerned. So compare your historic volatilities to the implied volatilities in the options to see if the options are high. If they're high, maybe you want to stay away. If they're low, maybe you get on the buy side. If they're high, I think that maybe it's something you could sell. Maybe you'd sell a credit spread rather than selling a straddle or a strangle. So look at your historic volatilities, compare them to your implied volatilities. You don't always have to get fancy and do straddles, strangles, backspreads. You don't have to be fancy and do those. If you know a company, you like the company, the earnings reports say that stock is going to go up, everybody's positive on it, look at getting in early and buying the call and playing for the move up. As volatility increases, your stock price will increase. You get to a point where you say, okay, the volatility is at a high level right now, it's time to sell. Or do you say to yourself, hey, the earnings haven't even come out yet. When the earnings come out, the stock is going to pop again and I'll make even more money. That's something that you have to look. You have to look and pay attention to what's happening. How do I feel? And, a lot of times when we're put a position on, our feelings change over a period of time. But if your feelings start to change, make sure you adjust your plan for the option as to what you can and can't do. You may decide earnings with volatility increasing that it's time to get out of the trade. You may decide that it's okay to stay in the trade. It's something that you have to look at, something that you have to pay attention to. Well, I think we can see if we have any questions, Alex. I think we're ready for that now.
Thank you, Bill. It's always a pleasure to have you on our program, and I know our listeners value your perspective as well as the knowledge you're able to share with us. So with that, we do have a few questions today, but I'd like to remind our listeners that if you have further questions about the concepts we discussed today or the tools on the OIC website, or if we weren't able to get to the question you submitted, you can contact our investor services team at options@theocc.com. That's options with an S at theocc.com. And Bill, one of the questions from the audience we have, do I need special approval for my broker to execute spreads?
Okay, so yes, we do need special approval. It's a different level at most brokerage houses. You have to be able to prove that you have a knowledge of options, you understand what happens in options, and it's kind of funny because I discuss this all the time with compliance professionals in the business, and when I just go out and buy a call, my risk is the premium that I pay for that call. But if I do a call spread, I buy a lower strike price, sell a higher strike price, I've sold something and brought in some cash to reduce my risk. So it's actually a less risky position than a straight out call buy. Now, that's great, it's less risk, but what a user has to understand is that they're giving up something for that less risk, they're giving up the upside. And the compliance professionals tell me that you have to, as a customer, be able to demonstrate that you understand what happens with the short side of the call. So it does take special approval from your broker. I encourage you to talk to your broker, ask what you need to get that approval. I think that it's a smart idea for everyone to be approved for spreads because they can help you out in numerous situations. They can help you in situations when you're losing a little bit of money. They can help you reduce risk. They can help you sell off the upside that you don't want. So yes, you need special approval. Please do yourself a favor and find out how you get it and work towards that.
Great. Another question from the audience. I like the idea of selling when volatility is high, but isn't that risky?
Yes, it's risky. It's particularly risky if you sell uncovered calls. If you sell puts when volatility is high, you're assuming the risk of owning stock. So selling puts is less risky than selling calls. Now, you like the idea of selling calls, and that's a very risky trade. But instead, turn that into a call spread. So let's say you sell the 25 call. 25 strike price call, go out and buy the 35 strike price call. It's going to cost you a little bit of money. It's going to eat into a little bit of the premium you brought in on the 25, but it's going to limit your risk to 10 points. Because if the stock goes to 50, you get called away at 25, you buy it back at 35, you only lost 10, even though the stock is at 50. If you just sold 25 calls uncovered, when the stock went to 50, you would have 25 points at risk. So if you like the idea of selling premium when volatility is high, look into doing it as a credit spread.
Great. And then I have another question here from the audience. Why do some call prices drop even after a good earnings report?
That's a very good question. So think about volatility now. So I own, I'm looking at a stock. I think the earnings are going to be great, and I think the stock is going to go up. And I go out and I buy a call option. And I buy a call option, and the volatility is, I'll be ridiculous for a minute. The volatility is 95, right? So 95 volatility, very high volatility. So I go out and I buy this volatility, buy the call with a price of 95. I pay, a nice premium for it, but I am very sure that the stock is going to go up because the earnings are going to be great. Well, you know what? I was right. The earnings were great, and the stock went up. The stock goes up. I should make money with the call. But what happened is the volatility goes from 95 to 40. So that volatility drop, which has a huge impact on the option prices, that volatility drop brings the option premium down, and it more than offsets the increase because of the stock rising. So a lot of times when you see a call price go down after earnings, and they're good earnings in particular, good earnings and the call price drops, it's because the volatility in that particular option came down. And that's why we tell you that, look at volatility, learn to look at volatility and learn how to use volatility, and you hopefully will avoid some of those situations.
Interesting. I have another question from the audience here. Do you know of an indicator that shows implied and historical volatility? Do you know of such an indicator?
I don't know what the question means by an indicator, but you can look at most brokerage houses and get implied volatility in your option chain. So you have to look at who you use, and a lot of times in the option chain we'll list the Greeks, so list delta, usually list delta, the theta, and the vega, which is the implied volatility. So you can get it there. Historic volatility, you have to go back and look at some charts. So maybe your brokerage house would have them, or there's several places that are available that had it available for years, which was ivolatility.com and impliedvolatility.com. And I am pretty sure that you can get historic volatilities through OIC now, Alex. Maybe you could answer that some other place. But I think you can get historic volatilities through OIC now.
Great. Thank you for that. And ladies and gentlemen, thank you for your time today. While we were able to get to all of your questions, I know several people submitted a bunch of questions in the last couple minutes, but we do have our investor services desk ready to help, and they would be able to provide a little bit more information as well as background to what Bill was discussing today. Feel free to reach out to them at options@theocc.com. Again, that's options with an S at theocc.com. For further education, please visit optionseducation.org, the OAC's website, and see the Getting Started section for further reading. Finally, be sure to follow us on social media, like our Facebook page, follow us on Twitter to stay current with OAC's latest offerings. Thank you again for attending, and we hope to see everyone next week.